Whenever markets reach all-time highs, the panic headlines start rolling in. Is a crash coming? But the real question nobody prepares for isn't whether the market will drop. It is how long you will be trapped underwater when it does. Most investors make a fatal mathematical assumption. If a portfolio drops 50%, you don't need a 50% gain to get back to even. You need a 100% gain just to see your original principle again. We are looking at the hard data from the 6 biggest crashes in history: 1907, 1929, 1974, 1987, 2000, and 2008, to uncover the exact timeline patterns and how markets fall and how long they actually take to climb out. When you analyze the data, market downturns divide into 2 completely different buckets. Bucket 1, mechanical and liquidity shocks. Look at October 1987, Black Monday. It was violent. Automated portfolio insurance triggered cascading sell orders, and the market dropped 22% in a single trading session. But because the underlying financial system did not break, the bottom was reached in just 3.5 months. And the previous high was fully reclaimed in under 2 years. Compare that to bucket 2, structural balance sheet collapses like in the 1907 crisis or the 2008 financial crisis. When the plumbing of the banking system freezes and balance sheets contract, the bottoming process takes anywhere from 17 to 33 months. In 2008, the S&P 500 fell 56.8%, and it took 5.5 years, over 65 months, for an investor buying at the absolute peak to break even. Then we have valuation resets and debt deflations. In the 2000 dot-com crash, the S&P 500 fell 49.1%, while technology-heavy sectors plummeted far more. The market took 2.5 years just to find the bottom in October 2002. The total time required to break even on the broad index was 7.2 years. And of course, in 1929, the nominal price index dropped 86%, and it did not touch its prior high until 1954, a massive 25-year drawdown. But here is the historical nuance most people miss. Because consumer prices deflated dramatically and dividend yields hit double digits, an investor reinvesting cash dividends recover real purchasing power in roughly 15 years, not 25. The inflation trap, 1973 to 1974, the most deceptive trap in the market history. So, what is the actual recurring pattern across more than a century of market history? First, the fall. a major structural bear market takes between 1.5 to nearly 3 years to find its structural floor. Second, the asymmetry. The recovery climb takes 1.5 to 2.5 times longer than the sell-off phase. Third, the total hold. If you buy at the worst possible moment, the exact market peak, the average total round trip to break even in a structural crash is 5 to 7 years. Understanding these timelines fundamentally changes how you allocate capital. If you know a true recovery takes 3 to 5 years, you never keep short-term liquidity in volatile equities. And if you never panic sell during month 12 of a 24-month bottoming cycle. Market history does not repeat identically, but structural mechanics and human psychology rhyme every single cycle.